battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show. My name's Nick Stenger. We are the Stenger Family Office. For the past 44 years now, officially, it's been the Stenger family's mission to deliver both clarity and confidence to help secure your financial future. Here we are, episode 182, Trump's Tariff, Turmoil. I think we can all agree past couple weeks have been a little bit bouncier, a little bit more volatile than we've seen in recent history. But I will remind you, we have had volatility. Not too long ago, you may have forgotten 2022, the market was down 25%, and that's why you have to keep coming back to the show each and every week and get the clarity and confidence, the good news, the reasons, data, math, statistics, why you have to stay on your plan. Don't make the big mistake that the one person made by selling off. Now, I will give you a quick update here. That one person who sold off their plan out of our 600 clients, thank goodness, watched the show on Monday morning, emailed me by Monday night and said, Nick, we made a horrible mistake. We've got to get back in. You got to get us back into the market. We will never, ever, we promise, pinky promise, never, ever get off our plan like that again. So thank goodness. But boy, that was an expensive day. Cost them a lot of money. So thank goodness we got everybody back on their plan. Everything is going pretty good for the most part as far as people staying on their plans. I've been very happy with that. And today I'm going to give you my update on the tariffs and my outlook of where I think the S&P is headed. Might not be spot on for the next 8 months or 9 months or 12 months, but I'm going to give you my long-term view and why this could be one of the best opportunities to buy on record. But before we jump into the show this week, we do have our Wealth Insights Forum coming up very soon, next week already, if you can believe it. We've got 140 of you coming to the Four Seasons for our unbelievable flagship event in Houston, and we're going to follow that up with our other big flagship event in Naperville. Actually, it's Oak Brook this year, right by the airport, right outside the city of Chicago, Oak Brook, Illinois, in October. Don't miss that thing, October 16th and 17th, especially if you've never come before. We've got 3 unbelievable guest speakers. You've got to get up here for it. Gibson Steakhouse, and we're doing a 2-day conference like we did last year here in Naperville. But this one, October 16th and 17th, that's our Investor Day conference, going to be our best one we've ever done. Let's talk about the markets here today. Remember what's happened the past couple years. I want to walk you back in time a little bit. So if you think back to the very last all-time peak that we had in 2019 before COVID started, we were trading the S&P in January of 2020 right around 3270. Write that number down if you're taking notes at home, 3270. That was the S&P's level on January 10th of 2020. Then COVID happened. We dropped 35% in 2 weeks, one of the sharpest and fastest drops we've ever had. It was crazy. People were so worried and panicked and wondering what was going to happen, not just from a market standpoint, but also from a personal standpoint, from a job security standpoint. Inflation or unemployment had spiked to 12%. And the word that everybody was using was unprecedented. We had never shut down the entire U.S. or global economy ever and tried to function. Who knew what was going to happen? Thank goodness technology came to the rescue, saved the day, and everybody ended up being okay for the most part. Most of those jobs, in fact, almost every single one of those jobs came back, and we're at record low unemployment nearly today. So the S&P recovered. We posted an 18 to 20% gain with the dividend by the end of 2020, so thank goodness you didn't sell off your plan. Finally then, now remember, Jerome Powell is going around today acting like a hero, that he saved the world. He saved the U.S. He's the best Fed chair of all time. And I'm not going to tell you what I think exactly of him today, other than to say in 2020 and 2021, he completely bungled inflation. He completely goofed up interest rates. Why? He said everything that happened with inflation was transitory and that we would not have long-lasting entrenched inflation. Well, we were listening to many other people at the time, including Professor Jeremy Siegel, including Brian Westbury at First Trust, who said, no. We subscribe instead to Milton Friedman from the University of Chicago, who won a Nobel Peace Prize back when they actually carried some weight. And he said inflation is always and everywhere is a monetary phenomenon. Inflation is always and everywhere too many dollars chasing too few goods. So what does that all boil down to? Inflation is the government printing money. That's the Fed. Now, We didn't have inflation like we have today. We didn't have it for the past 50 years until the Fed was created. And the Fed was created by large banks. Why? Because the Fed's mandate is two things: low inflation, low unemployment, and really not just low inflation, but they like to have a target rate of inflation. You ask yourself, why would we want a target rate of inflation? Wouldn't we want zero inflation forever? Wouldn't we want our dollar to keep its buying power over time? The Fed says, no, 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 no. All the banks that set it up, like JP Morgan and all the rest of them, said, if we can create a central bank, we basically print our own demand. So understand this: inflation is caused by the government printing money over time. And if you don't believe me, all you have to do is look at two metrics. You can Google these metrics. You can look them up on your own. One is monetary supply. That's M2, money supply. Number two is CPI, and that's the consumer price index. Okay, so that's what we pay for our goods as consumers. And there's the PPI, that's producers, that's businesses, their input costs. And if you track these numbers together, especially CPI and M2, they're almost 100% correlated. In fact, now, over the past 200 years, CPI inflation has gone up about 3.5%, not the 2% that we've gotten used to. So if your financial advisor is still using a 2 or 2.5% inflation assumption in your financial plan, watch out, because you could be in for a world of hurt 20, 30 years from now, and you could be really far off your original plan's mandate. And by the way, if you don't have enough equities, you could be really far off your financial goals long term. And so you have to understand why inflation is here. Inflation is here because the Fed has been printing money. Now, how much does the Fed print per year? Well, we printed a bunch over the past 4 or 5 years with COVID, but over the past 100 years, we have printed roughly 3.5% per year. You're like, whoa. That sounds a lot pretty familiar to CPI at 3.5% per year. That's exactly right. So the Fed causes inflation over time. We get a devaluing of our currency. We get a decreasing buying power of what our money is worth. And this is what Brian Westbury has pointed out. When you say, hey, my pizza costs more than ever before, it's not really that your pizza costs more than ever before. It's that your dollar buys less pizza. Be very, very clear on that fact. Now, this all goes back to the S&P 500. In December of 2021, finally, Powell realizes his massive, massive mistake. He realizes that inflation is not transitory, that it really was possibly caused by printing too many dollars into the economy. And he starts this aggressive cutting, or we would even call it a hawkish Fed. We would call it a tightening cycle. He starts this aggressive tightening cycle at the end of 2021 and into most of 2022. So you'll remember we went from 0% interest rates, where a 30-year treasury would pay 1 or 1.5%, a 30-day treasury paid 0.5%, to all of a sudden now rates were 5.5% on the short term. That's a major change in policy. And so all these people trying to give Jerome Powell a Nobel Peace Prize for crushing it at the Fed really don't have perspective, because he is the person, in my opinion, who caused a lot of this runaway problem in the first place. So he allowed, and get into politics if you want, but this happened under President Trump, and it was continued under President Biden. At some point, there should have been some fiscal discipline. We should have never passed the Inflation Reduction Act. We should have never passed, which is goofy that they even called it that. It was completely backwards. It caused inflation. We should have never passed a lot of these follow-up bills. And again, I blame the Republicans. I blame the Democrats. And they're both responsible for the massive amount of money that went in the system. But it was Powell's job to put a stop to that, or at least slow it down. And so he should have at least been 1 or 2% interest rates, not 0%. And because he was so late to the game, because he didn't raise rates at all in 2021, thinking inflation was transitory, well, then in 2022, then the problem really started to catch up with us. And you started to see the prices at the pump go up. You started to see the price of eggs and groceries go up. You've seen the price of goods go up. Look at the price of homes the past 5 years. And so if you don't believe that the government causes inflation by money printing, well, guess what? M2 money supply is up about 45% the past 5 years. Guess what? The average median home price is up the past 5 years, about 45%. So it's just math. And so if you sell your house today, you're feeling pretty good. Hey, I just made a 45% profit, right? Well, guess what? Wrong. Now you got to go buy another house, and that new house is also up 40 or 45%. So because the government does this over time and we print money into the economy, nobody is really better off. The only people that can even survive the inflation, the only people that can deal with it are the people who have assets. And I've told you this a million times. So if you have assets, you're okay. And so if inflation's up 45%, well, guess what? Thank goodness your house is up 45%. You're break even with inflation. You're not really ahead, but you're at least break even. Same thing with asset values. Same thing with the price of stocks and the price of other assets that you may have. You've even seen gold now rally a little bit. And so asset values have gone up with the rate of inflation. Now, the S&P 500 in particular, and the top 50 companies in the S&P 500, that's the best 50 companies in America, which we focus on primarily for our clients, have even beaten the rate of inflation more than just that base 45%. And so why is it that equities are the best inflation hedge over time? Well, there's really two reasons. One, they raised their prices to break even with inflation. So if they had a 10 or 12% profit margin in 2019, they can at least maintain a 10 to 12, maybe 13% profit margin today. Now, where the left of the political aisle gets this wrong is they say, well, Nick, profit margins are higher than 10 or 12% on the S&P now, so it must be price gouging. It must just be greedy corporations. Well, there might be one or two greedy corporations out there, but I can tell you that the increase in margins has really not helped the grocery stores. So all these people on the left who have said, oh, we got to go after the grocery stores and the companies that make washing machines and all this nonsense, just don't understand that their profit margins are literally almost the same as they were 5 years ago. But what's different are the profit margins of technology companies and companies that really have had just great corporate strategy, good management teams. And where do they get their additional margin from? Well, they don't get it from just raising prices just for fun. They've got an additional profit margin by reducing their input costs, by using technology. So the saving grace of the equity market over time is the fact, one, we can raise prices to keep up with inflation, but number two, that we can leverage technology to reduce our input costs. And while we reduce our input costs, life gets better for everybody. So this all gets into tariffs and trade, but I just wanted to say that don't be alarmed that we're having this pullback now. Yes, it's partly due to tariffs, but we had a 25% correction in 2022. We did go into a technical recession that nobody talked about, since they didn't want to call attention to their person in the Oval Office at the time. But that is true. We did have a technical recession in 2022, followed by a recovery. But what was the Fed doing in 2022 that they're doing today again? They were tighter than people thought on their policy. So don't be alarmed if you see more chop from here. And just because we get a trade deal announced with China in the next month or 2 months or whenever it would be, doesn't necessarily mean we're going to rip right back to all-time highs overnight. In fact, it could be that the Fed is still trying to stay tight on their inflation, on their monetary policy. And if that's the case, we could be back into these wilderness years that I've talked about in 2022. They're not the all-out Armageddon years. It's not that the sky is falling. It's not that the world's coming to an end. It's rather that we just bounce around for a while. We will eventually get to all-time record highs, which I think the future record all-time high on the S&P will eventually be 7,000 points. It just may take a while. So here we are today. What do you do with your portfolio? And then we'll talk a little bit about tariffs and trade and Trump's endgame, I think, with tariffs. But what do you do with your plan today, despite tariffs, despite the Fed, despite everything that's going on? You get invested now at 5,200 points on the S&P. And if you can pick it up at 5,000, great. You get an A+. If you pick it up at 4,900, A++. But for most of us, we're not going to be able to pick the bottom exactly. Rather, what we want to do is get our money to work today right at that 5,200 point zone. And so if we eventually, or I should say when we eventually get to 7,000 points on the S&P, let's say it takes us, let's just say 3 years, just as an example. With the dividend, we are looking at 12% annualized returns the next 3 years. That is phenomenal. why would you try and time it other than that? Why would you not get in? Why would you wait? Why would you try and figure out when the bottom is and the top and short and all this nonsense trading? And I did send out an email a couple weeks ago where I told people, I said, we are not traders. We are not market timers at Stenger Family Office. You may be watching what we're doing at the portfolio right now and say, Nick, there hasn't been a ton of activity. Well, I would just warn you about all these advisors out there, so-called advisors, who are doing all this activity right now, that have made all these trades and all these different changes with the portfolio. And I would ask the question, why, if they had a good portfolio to begin with, a portfolio that was designed to stand up to things like this, why would they have to go and change everything now? That's a big, important question to ask. And so don't take a lack of lots of activity from Stenger Family Office during this time as we're not watching it or we're not doing it. I mean, we're watching it literally every day. But rather take it as we went into this correction already allocated pretty much where we wanted to be. And that's the goals-based plan. That's what I've been hammering home on the show every week, is if you have a goals-based plan, when these things happen, yes, the reaction is to panic and want to trade and do some activity. But the real reaction should be just wait. And I know that's not easy to do. I know that's not part of our human nature. Our nature is not to want to wait and be patient and see things through. But that, I think, right now is the best answer. So get your cash to work. Get your money to work at 5,200. Get it to work at 5,300. And you will be happy, because 3, 4, 5 years down the road, I think you're going to be up. But if you need to have a set of money in your plan, you're on that goals-based plan, and you're nearing retirement, you're a few years out maybe, or you're a few years into retirement, that's where we would say, get yourself on a goals-based plan. Let's just say you got $5 million, for example. I would say have $1 million set aside, safe and secure in short-term 30-day U.S. Treasuries. We may change some of that eventually if we think yields look good on preferreds or high yield, for example. But for the most part, keep that money safe. On the other 80%, let's say you got the $5 million portfolio. On the other $4 million, that's where we're going to go out and grow the portfolio. Why? Because we got to beat inflation. And that will provide you with the cushion you need in the portfolio to get through these bad times. Now, how bad is it really right now? And that's where we get into this current correction with tariffs. We're down about 15% from the all-time high. So do not lose heart. Do not panic. The world is not coming to an end. I can assure you of that. You are going to be okay. We had a 25% correction, like I keep saying, in 2022. We had COVID, we were down 35%. We had 2018 with tariffs, we were down 18%. And remember, the reaction that we would have, our nature would be to say, it's never been this bad. Well, this one's different. This time is different than all the rest. Well, they've all been different than all the rest. Every single one of these, from Grexit to Brexit to COVID to Trump's first round of tariffs to 2022 with the Fed tightening cycle to tariffs again today to whatever's coming in the future, it's always going to be a little bit different. But the constant is that every single one of those times we have made it through. We will make it through this one. I can assure you of that. It just may take some time. We will make it through. And the other thing that's true is this will serve as a phenomenal buying opportunity if you're on a goals-based long-term plan. So do not get lost in the sauce here. Don't get wrapped up in the noise. Don't let the media trick you into making a terrible decision, because, again, they have no responsibility to you to keep you on a plan. They have no responsibility to a 30, 40-year time frame like we do as fiduciary financial advisors. Listen to the people who are right there alongside you, who are incentivized to keep you on that plan. And if you do that, you're going to be okay. So stay on your plan. If I can give you one thing today, again, is to just stay on your plan. Don't be surprised if we bounce around here in the wilderness again for a little bit, but we will get through it. It just may take a little bit. Don't log into your Schwab account every day. How about that for starters? Go find something else to do. Find a different hobby. Do something different. Enjoy your friends and family and your kids and your grandkids. But just stay out of your Schwab account for a few months, maybe a year. and when it's all said and done, you will be so happy you just stayed on your plan. Now, here's where I want to end with tariffs. And I could be very wrong about this, but this is what I see. Number one, Trump's target number one, public enemy number one, is China. That's already basically been proven. I called that before any of the other tariffs on the other countries were lowered or paused temporarily. Okay, so we've told you, we give you tomorrow's news today. That's tomorrow's news today. Go back and watch the episode. I told you the tariffs were really mostly about China, and that is all true. Why? Because China deserves to pay. And I'm not saying this as a political statement. I'm saying this as when our companies go over there and do business, they got to take off their pants. They got to show them everything they got. They got to give them all their IP, and the Chinese steal it. Okay, that's just the reality. They steal our company's intellectual property. And if you do that, you're not playing by the rules. When we let China into the WTO in 2001 and we gave them favored nation status, the idea was to lift them out of poverty using capitalism. Well, that's happened. But now as time has gone on, they have not played by the set of rules that they were supposed to play by. And so if you don't play by the rules, you deserve to have a consequence. Now, the other thing that China did is they unleashed COVID on the world. And you can debate this if you want, but you cannot debate the Senate report that came out and said, yeah, pretty much bipartisan group of Republicans and Democrats, China caused COVID. And so now President Trump's, I think his view, I've never talked to him, I've never met him, I don't know exactly what he's thinking, but my take on this is he is really targeting China for those two things. It has not been fair how they've treated our companies. It has not been correct the way that they've handled things, and he wants to get them to pay. Now, the other thing I'll just say is I think China depends on us a lot more than we depend on them. Why? Because the world doesn't operate in a vacuum. So all these goofballs out there who are saying, oh, Nick, are we really going to want to manufacture iPhones in the U.S. and Nike socks and shoes and shirts and all this nonsense? No, of course not. But the world doesn't operate in a vacuum. Just because we penalize China or try to penalize China for what they've done doesn't mean that we're going to bring back a Nike factory to the U.S. All we have to do is deal with China. So don't lose sight of this. And look at what Trump's doing now. Now, again, take this for what it's worth. I'm not giving you an endorsement. I've already told you stuff I didn't like about Trump the last time he was in office with COVID, and I'm not telling you tariffs are the best way to deal with this time, but I'm telling you what I think he's doing. If you look what he's doing in Latin America, okay, is he has put all eyes on the Panama Canal. The Panama Canal is a big deal. It's one of the most important shipping routes. Otherwise, you got to go all the way under Latin America, and it's really treacherous and takes a long time. Well, the Chinese have a massive leg into the Panama Canal, and so he wants to deal with this his way. Now, I'm not telling you his way is right or wrong or anything like that. I'm just telling you that nobody's dealt with it in a generation, and this is the first time that we're trying to deal with China. So all those Nike factories do not have to come back here. The iPhone factory doesn't have to be in Naperville, Illinois, right? But it does need to leave China, and you're already starting to see early signs of this. Apple already announced they're moving iPhone production to India. They're moving some to Indonesia. They're moving some to Mexico. And by the way, Trump has really given Mexico a break here on the tariffs. He's also done a nice job with the Canadians, in my opinion, and he knows that our best trading partners are the Mexicans and the Canadians, and he created the first trade deal with Mexico and Canada. So we could really end up having a wonderful trade deal done where China again suffers in the end, which is the main goal of what he's trying to do, and the rest of Latin America, India, some of the other emerging market countries are really lifted up. So what's wrong? This is my opinion. But what's wrong with creating some competition between countries? I don't think there's anything wrong with that. The world is not a vacuum. We can deal with China in the context of getting companies to do business in other places. And if you were a company, you would do this. You would never, ever, ever, as a company, want to have all your risk with a supplier at one place. You would never take on supplier risk where everything that you do is relying on one provider. If you did that, you're toast. If something goes wrong, you're not diversified. And that's really the point of what we're trying to get done with tariffs. And again, I don't know if tariffs are the best way to do this. I actually think the better way to do this is you just say no more Chinese U.S. investment in Chinese companies. And you have to understand, we own about 6.5% of outstanding Chinese companies. China only owns about 0.23% of ours. And by the way, all the people that say China's going to dump all its treasuries, well, where are they going to go? Oh, they're going to go to the Bund? Really? It's a $2.7 trillion market, okay, it's not even going to be close to being able to handle the amount of treasuries that China holds from the U.S. And so it's just not logical. China needs us a lot more than we need them. And I believe eventually they're either going to have to come to the table, or what's going to happen the first time in 2018 where is going to be where all these companies leave China permanently and they go to other places. And that would be a healthy thing for the U.S. to diversify its supplier base. One thing I will warn you of is we are actively fighting a war with China right now. I just want to be very careful to point this out, because the last time that we did this with China, the last time we fought this trade war, they unleashed COVID on the world. Okay, well, this time around, just watch out, because if they get backed into a corner enough, they could do something else, unleash another problem on the world. And if you listen to the World Economic Forum, you listen to these scary people like Klaus Schwab, and they're like straight out of an Orwellian novel and all this stuff. It's like, you will eat the bugs and be happy. You'll own nothing and like it. That's these kind of people. Okay, well, these people are now saying, be careful, the next pandemic is going to be a massive cyber attack. So call me a conspiracy theorist. I'm really not. But you can see some of the cards aligning here with some of the way that the Congress people are trading. Remember, the Congress people, they can insider trade as much as they want. If any normal person on Wall Street insider traded, instantly in prison, okay? Well, Nancy Pelosi and Chuck Schumer and Mitch McConnell and all these people in Washington, the dinosaur class, they can trade as much as they want on insider information. Well, what are they buying? They're buying cybersecurity companies. What's Stenger Family Office done in the past? We've bought some cybersecurity companies. So just be aware of the fact that this thing ain't over yet. And it could be on a 1 or 2 or 3 year delay. But if China's really backed into a corner enough here, they will do something that could shock the system. So all this to say, if you're buying in today at 5,200 or 5,300, or you bought in at 6,000 and you're down 10 or 12% now waiting for a recovery, it's coming. Don't worry about the long term of the plan. But I do want to just point out, don't be surprised if it takes a little bit to work through this. I think ultimately we will reach all-time highs. This will be just like Ronald Reagan in the 1980s. 1981, he had to deal with all the mess that was created the years before him. And 1981 was not a good year in the S&P. We went down 9% that year. Well, that was followed up by 7 of the best years we've ever had in the stock market. Sometimes you have to have a little pain to eventually have some gain. And I think that's where we're at today. So please don't walk away from this show, saying Nick's got this big time political opinion. I'm just calling it balls and strikes as I see it. And we have called out Trump on things we think he was wrong on. We've called Biden. We told you things about Biden we thought he did well. But these are the things I see going forward that could affect the portfolio, and you need to be aware of them. All that to say, be on your goals-based plan, be on your long-term financial plan, and all this will work out for you in the end. Thank you for being on this episode of the show. Don't forget to like it, share it, subscribe to it. The subscribership really helps us out. We so appreciate everyone who has done that, who has subscribed to the show. Do that on YouTube, Apple, and Spotify. It helps get it to more and more people. We'll see you next week in Houston, and then we'll see you in October for Investor Day. Don't forget to register for both those events. We'll see you soon.